World Economic Forum, where Shereen is in conversation with Gita Gopinath, the first Deputy Managing Director at the IMF.
Welcome back. We continue our conversations here at Davos 2025. As I've been saying, this is proving to be a Trump Davos. All eyes were on what President Trump had to say in his inaugural speech yesterday and what the impact and the implications are likely to be for the world economy. Joining us now is the IMF's Gita Gopinath. Gita, it's always a pleasure. Thanks very much for joining us here in Davos. Were you up watching the speech last night?
Hi, Shereen. Yes, I was up for quite a while, but I have several colleagues of mine who are also following it from Washington, D.C., so we got the whole coverage.
But so far along expected lines and somewhat vague still on tariffs and how those are going to play out, especially when we talk about China.
Yes, I mean, and President Trump said he would hit the ground running on day one, and that's what he has done. And he has made several announcements, some very specific on immigration and on energy. On tariffs, again, there is intention, but we still have to wait for the details. So I think, again, it's too early to come up with an assessment of what these policies will mean.
Yeah, I would imagine we will need to wait for the details to understand the implications and the impact. But Gita, let's talk about global growth. And you put out the IMF put out its World Economic Outlook just before Davos, 3.3 for 2025 as well as 2026. And of course, this is below the historical average that we've seen through the 2000s. Do you believe that the downside risks to that projection are higher today on the back of what we are hearing from the Trump administration?
If we look at the very near term, I would say that there are both upside risks and downside risks, but they apply differently for different countries. So in the case of the U.S., there is a lot of positive sentiment. There is a lot of anticipation of deregulation, including also on making the tax cuts permanent. So that could give a positive boost to the U.S. economy, keeping the other policies, even if the other policies are implemented on immigration and on trade. So we could see a near-term upside risk to the U.S. economy. But for most other countries in the world, the developments on the trade front, on the policy uncertainty that's there, the higher borrowing costs that we now have, especially at the 10-year end, because the U.S. economy is as strong as it is and inflation remains something that they have to watch very carefully. The strong dollar, all of that puts more downside risks on many other countries in the world.
Let's focus a little bit on the U.S. and what you expect there in terms of both the tax cuts as well as the tariffs and the impact of those. Do you expect the Fed to be able to cut rates in 2025? Because, the expectation was that perhaps one, but now we're starting to hear maybe none. What's your own take on what's likely?
The U.S. economy is strong. The U.S. labor market is stronger than we thought it would be at this time a couple of months ago. So the indicators point to an economy that, even given where interest rates are now, is able to hum along. And therefore, I can see that the Fed will be cautious about any further rate cuts, and they're going to track the data and they're going to follow the data. And also, the impact of all the new policies that are being announced will matter in terms of what the impact will be on inflation. So I think they are on a wait-and-see mode. There's the usual data-dependent approach. And yes, compared to last year, even as, middle of last year and so on, where there were expectations of many more rate cuts, this year, I think, it's gone down to one, and we'll see.
The dollar strength and what that means as far as emerging markets go and emerging market fund flows. We've seen a little bit of a change overnight on account of the expectation on tariffs and that not being sort of confirmed just yet. But how do you see the bond markets as well as the dollar strength impacting what happens to emerging market fund flows?
This is certainly we're seeing movements in the bond market in terms of 10-year Treasury yields, more volatility than we had seen in that decade after the GFC and before the pandemic. And a couple of things have changed. One, we are no longer in the world of a global savings glut. There is a lot of public sector debt on the market. In the U.S., public sector debt is also quite sizable. And that is feeding into some of the long-term yields going up, including that right now, I think inflation expectations also are putting some pressure on the long-term rate. So that this space that we're in now, with the expectation that interest rates may stay higher for longer in the U.S., is certainly spilling over to the rest of the world. I mean, an interesting fact is that usually in previous cutting cycles, when the Fed cut rates, rates fall across the whole
Yeah.
yield curve. But this time we've had, since September, about 100 basis points of rate cuts, and we've had 100 basis points of increases in the 10-year Treasury. That is not typical. And so this is a different time, and it is a reflection of the fiscal stance, it's a reflection of inflation expectations and what it will take to make sure inflation stays close to target.
The possibility of deregulation across different sectors, that is what President Trump has promised. And the expectation the banking sector also has, the financial sector has, for deregulation as well, to do with capital requirements and perhaps more. A conversation that I was having with Kenneth Rogoff here yesterday, and that's one of his concerns, that, this could perhaps be an undoing. How do you see what is being promised or what is being speculated on as far as deregulation for the financial sector and what that could potentially mean?
Here again, I think we wait to see what the details are. There is something like an optimal level of regulation that's important to balance the risks that can come from a lot of credit in the economy versus the benefits of it. There is a sense in which there may have been a bit of overregulation, and that needs to be pulled back. But at the same time, one of the reasons why we didn't have any kind of a financial crisis, despite having a major pandemic and a big energy price boom and cost of living crisis and so on, is because of the reforms that were put in place to keep the banking sector safe. And so regulation is absolutely important. There has to be the right balance for it, and we have to see what exactly this administration will do.
Cryptocurrency and the way that we've seen President Trump back cryptocurrencies, as well as the move that we've seen in the Trump meme coin. What do you make of it, Gita?
Yeah, so, firstly, we don't comment on any commercial products that are out there. But, I can talk more generally about how we see crypto. Again, it is, again, one of those areas where there are risks and opportunities. In terms of the opportunity, there are several companies that are using the technology that underlies it, in terms of the distributed ledger technology, to improve their payment systems and to improve the security and so on. So there's the technology that has benefits for it. But it is important for countries to have the right cyber policy framework to make sure that consumers are well protected, that you're not building up financial risks and financial stability risks, and you have to get that balance right. That is important.
Do you see that this is perhaps the start of building up those kinds of risks?
Again, it depends upon who is putting their money in these markets. We have many kinds of asset classes where there's a lot of speculation that goes on, and animal spirits and so on. So, so it depends upon who's going to affect it if you do have corrections in these markets. And usually it takes a lot to have a systemic financial stability effect. You need to have the banking system either to have very large exposures or households to have very large exposures. It's still early days for any of that.
Absolutely. So that's not a key risk as far as from a systemic point of view.
As of now.
As of now, with that caveat on the table. But let's talk about India. The outlook that the IMF has put out pegs growth at 6.5%. Still one of the fastest growing large economies in the world. What do you like about India today? And in the context of what we will hopefully see in the budget, what would your expectation be?
So firstly, just to emphasize what you said, which is, India remains the fastest growing large economy of the world. We do expect to see growth to recover in the second half of this fiscal year, which is how we get to 6.5% growth. So for us, potential growth for the US, for India is 6.5%. To get to much higher levels of growth will require structural reforms on many fronts. Also, it will require continued public infrastructure investment, which the government has been doing a lot of, but you're going to require that at the central government level, but and the state government level, and to be able to execute on a timely basis, that's going to be quite important. There's also the more long-standing issues in terms of the ease with which you can start a business, the ease of doing business, the ability to buy and sell land, labor reforms. All of those are required. And lastly, we're now in a world where companies are looking around for how to build their supply networks. And India is an attractive destination for them to do it. So this is an opportunity for India to be able to plug itself more firmly into global supply chains.
You know, from that perspective of being able to plug ourselves into the global supply chain, and that's a work in progress at this point in time. We're seeing different sectors do things differently. You know, what would the 2 or 3 recommendations be on what we should prioritize in terms of policy?
So firstly, again, infrastructure in terms of port infrastructure, road infrastructure, all of that transportation is extremely important to be able to plug into the global supply network. It's also important to have a much more confidence in terms of what the regulatory environment is going to be, what the tax environment is going to be. That's going to be critical too. And lastly, tariffs will have to be lowered because if you want to be a major exporter, most exporters also import inputs from somewhere else in the world. And therefore, having the right level of tariffs and India is, I would say, on the higher end, bringing some of those tariffs down is going to be important to be a big player in the global supply chain.
I also want to talk to you about what's happening in the currency markets, including, of course, what's happened with the rupee. And we are seeing moves across the world at this point in time. But from an India perspective, a depreciating rupee, what will that mean, especially when we talk about our aspirations to be a manufacturing hub and so on and so forth?
So this is as you've said, this is a common phenomenon, right? We have the dollar that is strengthening relative to almost all currencies in the world. And India is one of those countries where the rupee has depreciated. So the question is, what are the consequences of that? And now, usually the implications are, one, it has an effect on inflation. And the second is that it can be a problem for countries where you have a lot of foreign currency borrowing. In the case of India, thanks to its monetary policy framework, inflation expectations are well anchored. There's a sound monetary policy that's taking place, so I'm less worried about that. And in terms of foreign currency exposure, is much less, especially public debt. I mean, there's very little. And so those are not the direct concerns. But without a doubt, we see if you're a country that has a stronger macro framework, you're going to be much less hit with all these new developments. And so we're going to see currencies move around quite a bit. The more you can do in terms of building domestic strength through your domestic reforms, those will be great offsets for these kinds of pressures.
China, Gita, before I let you go, the expectation of more measures, more stimulus, what's your own take on what that could potentially mean?
So the China government is also, moving very strongly in terms of both fiscal policies and monetary policies. And that's one of the reasons we've slightly upgraded growth for China for this year. But there are still some very big issues to deal with. One, for example, is in the property market. We have this problem of unfinished homes that households paid for, they haven't received. And that is a negative sentiment for several households, and that's a problem, which is why we don't see much in terms of consumption, spending, recovering yet. That's something they need to invest in. Making sure there's less, the resources are going to where the best opportunities are. Having a more market-driven investment will be important to raise productivity in China, which also is critically needed.
So the headline for 2025?
Headline for 2025 is, stable growth, but with a lot of divergence and a lot of uncertainty.
Stable growth with a lot of divergence and uncertainty. That is the world that we live in. And of course, a lot of this is going to be digested as the details are decoded and as we do actually get access to the details. But thanks very much, Gita. It's always a pleasure. Appreciate you joining us here in Davos on CNBC-TV18. Look forward to seeing you in India through the course of the year. We will take a break, but the conversations continue. We're going to be back with you in a moment. Don't go anywhere. Right back with you.